Hello class, this will be my lecture for chapter 9, Accounting for Current Liabilities. So current liabilities include a bunch of different accounts. Some of them are already familiar to you. Um, we will talk briefly about different ones. The most focus in this chapter will be on payroll and also on warranty. So payroll transactions, payroll liabilities, and warranty is going to be my focus here. Current versus long-term liabilities. This is a definition of any liability, right? The liability always has the word payable in its account. Sometimes it might have a word unearned. Unearned revenue would be also liability, so either unearned or payable. A company has a present obligation. We owe something today due to a past event for future sacrifice. So today I owe $1,000 to Office Max because 20 days ago I bought supplies on account, and 10 days from now I have to pay money. I have to sacrifice usually money, cash, or any kind of asset. Now, current liabilities we have to pay within a year or the company's operating cycle, whichever is longer. Long term, I expect it to be paid in more than 1 year. Many liabilities have two portions, current portion, long-term portion. If you think about pensions, a company has a current portion of pension liability and long-term. If you think about your car loan, auto loan, right, there is a current portion that comes due this year as well as long portion. Mortgages are the same way. So here is an example from Southwest Airlines. These are their current liabilities. They're coming due within a year. Accounts payable, accrued liabilities would be payroll liabilities, air traffic liability, probably the amounts of money they owe to different airports or federal agencies. Current maturities of long-term debt. These are current, this year's portion of any kind of loans or mortgages they might have. Now, we will classify current liabilities based on three uncertainties, right? There's three types of uncertainties. Whom do I have to pay? When do I have to pay? How much I have to pay? If I know for sure accounts payable, I owe to Office Max, I know whom I have to pay. I know I owe it to them in 30 days, in 10 days, in 45 days. My credit terms are very clear, and I know how much I owe them. I owe them the full amount of the invoice, or I can get a discount depending on the terms. So an accounts payable has no uncertainty. So we classify accounts payable with the name known liabilities. So known liabilities, we know all of these three uncertainties. And then we will have second group called estimated liabilities, where there will be some uncertainty, whom to pay, when to pay, how much to pay, but we would be able to estimate those. So the first group is known, the second group is estimated, and the third group will be called contingent, where the level of uncertainty is very high. So for known current liabilities, these are different examples. You're familiar with all of them. Accounts payable we covered, sales tax payable we covered, unearned revenues we covered, notes payable we covered. The new one is payroll liability. So sales tax payable, here is an example we studied it a little bit in chapter 4. Unearned revenues, please make sure you review those. Students do not like, for some reason, this account. It's a liability. Let's say Rihanna sells $5 million in tickets in advance for 8 concerts, June 30th. She has not performed her concerts yet, so we debit cash and we credit the liability. She is not allowed, or her company, her production company, to record it as revenue until she performs her concerts. So this is a liability. Minus plus goes up. When you credit the liability, it goes up. By October 31st, she performed 1 concert, right? So she earned $5 million divided by 8 concerts. She earned $625,000. So at that moment, so you see here, we received cash in advance, right? That's why sometimes these revenues are called deferred revenue. We receive cash first and then we defer and perform service later. On October 31st, she recognizes, that's an adjustment from chapter 3. We decrease debit unearned revenue and we record revenue account, ticket revenue. Notes payable, we covered notes payable also in chapter 3. Short-term note payable or current note payable charges simple interest. Um, let's say right here, Brady Company asks McGraw to accept $100 cash, a 60-day 12%, $50 note to replace its existing accounts payable. Like, for example, Brady owed us, where McGraw, $600. They can pay me $100 right now, but the difference, the balance, they cannot pay, so I accept a note from them and I will give them additional 60 days, but I will start charging them, but I will start charging them 12% annual interest. And then after 60 days, right, August 23rd, after 60 days, I will collect $500 back with interest. So right here on October 22nd, I'm collecting 500 back. The interest is 10 bucks. This is the formula from chapters 3 and 7, simple interest. P principal multiplied by R rate multiplied by time, 60 over 360 days, which is 10 bucks. So I receive a check for $510. We also talked about adjustments for the amount of interest at the end of the year, right? So make sure you go over these slides. I'm not going to go over this again because we covered it again in chapter 3 when we did adjustments and accrued expenses. And again, we did it from the perspective of a note receivable, but the calculations were the same in chapter 7. Payroll. So this is kind of a new information for you, especially if you did not take business 7. So we will have a lot of liabilities here. We will have a lot of new accounts here. We will use different expense and liability accounts to record payroll. So this is the idea right here. Gross pay, right, is pay before deductions. So gross pay will be some kind of, like we used to call it salaries expense or wages expense account. That's gross pay. And then we, the company, deduct all of this. We withhold this. We withhold federal income taxes, state income taxes, voluntary deductions for medical insurance, dental insurance, 401k. FICA taxes. There are 2 FICA taxes, Medicare tax and Social Security tax. All of these become liabilities. So we will add the word payable to all of them. Medical insurance payable, Medicare tax payable, Social Security tax payable. Because these are monies that we are withholding from employees. They become our liabilities, and then later we have to pay them to the government, to the IRS, to the state government, to the medical insurance companies. And what's left is take-home pay, right? Or net pay, which is gross pay minus the employee deductions. Net pay is also a liability. We will call it salaries payable or wages payable until I actually issue checks to my employees. This is the idea. We're going to debit this gross pay, and we're going to credit all of these accounts, right? You debit gross pay, you credit withholdings, and the last account you credit is salaries and wages payable, which is net pay. So Social Security tax, we're using this information for Social Security. Social Security, so FICA, the law, regulates 2 types of taxes, Social Security tax and Medicare tax. We're using old data. This is what we're using in your book. Social Security is paid at 6.2%. So if you look at your paycheck, you pay 6.2%. on all money you earn up to $118,500. This is confusing to students. This is the Social Security cap. In reality, right now, it's over $130,000, but we're going to use this cap, meaning if you make less than that per year, everything is taxable. Whatever you make above this amount per year per person is not taxed. So if I make $1 million a year, I am only going to pay Social Security on the first $118,500. That's called the Social Security cap or maximum. Medicare doesn't have a cap. If I make $1 million, $10 million, I will pay 1.45% on all gross pay, all wages. Now, employers will match this. So you and I pay 6.2% in Social Security, and then the same amount is matched by our employer. And the employer withholds my percentage, matches it, and sends a check to the IRS. And they do the same for Medicare. Federal income tax, guys, there are tables, there are ways to calculate it, but in this class it will be given to you. State taxes will be sometimes given, sometimes we'll ignore them. We do not have local income tax in the Bay Area. And also there is a bunch of voluntary deductions, right? We as employees pay for union dues, pensions, 401ks, medical insurance, charities, and so on and so forth. So this is the first journal entry, right? As I mentioned, this is very important. A lot of your homework is related to this concept. So you debit gross pay right here. This is gross pay. Salaries expense. Sometimes there is more than one account. They will be wages expense. So sometimes it's based on the department. Faculty salaries expense. Management salaries expense. So you could have multiple accounts. But this is gross pay. Gross pay. Then you credit all of this right here. Credit all of this. These are employee withholdings. These are employee withholdings, so deductions. How did they come up with $124? It's 6.2% of $2,000. How did they come up with $29 for Medicare? It's 1.45% of $2,000. Income tax, medical insurance, union dues, you have to be given this information. And what's 1,524? This is net pay, right? This is also, look at the credit. This is take-home pay, salaries payable. Debit gross pay, credit all withholdings. The difference plug-in is net pay. That's your first journal transactions. This is employee payroll. Employee payroll. This is a portion of employee payroll. First journal transaction. Second journal transaction is employers, right? What does the employer pay? The employer matches our FICA, our Medicare Social Security, and they also pay unemployment taxes, FUTA and SUTA. You and I, as employees, we don't pay them. Our organizations, our companies pay FUTA. FUTA stands for Federal Unemployment Tax, and SUTA is for State Unemployment Tax. So guys, in general, FUTA is, this is all you have to remember. Ignore all of this. FUTA is 0.6% on first $7,000, right? So every employee, as long as you're below $7,000 per year, the company takes 0.6%. It's very small. It's 0.006, less than 1%. So after I made $7,000 per year, my company stops paying FUTA for me. It's the cap. For SUTA, the rate changes, varies. It's also taxable for $7,000. So if you have an employee who is above $7,000, that's it. You don't pay FUTA or SUTA for them for the rest of the year. So sometimes in the problem, I'll tell you, cumulative earnings for this employee is $20,000 and the SUTA rate is 2%. Who cares, right? Their cumulative is already $20,000. So there's no SUTA tax for them. SUTA tax changes, it depends. So it has to be given to you. It has to be given to you. This percentage varies depending on the situation, depending on the economy, depending on the contribution, depending on how many people my company already laid off. The more people you laid off, the higher your rate becomes. So this is a second journal transaction. What do you debit? This is a new account. It's called payroll tax expense, new account. you usually don't know what it is. You list all your credits first, then you add them up, and that's the debit. This is the taxes that are paid by the company for payroll. That's why one of the reasons companies prefer to have independent contractors instead of employees, because then you don't have those taxes to incur. So Social Security, Medicare, if I go back to the first transaction, I just match it. Look right here, $124 and $29. This is what the employee paid. I just matched it. State unemployment. The employee makes $2,000, and they will give you FUTA is 5.4%, so it's $108. FUTA, the employee's gross pay $2,000, and it's should say right here. Let me change it. It's 0.6% or 0.006, so it's $12, and then we add it up and we get 273. So these are two journal transactions. They can get much more complicated than this, and your homework challenges you. But on the test, I'm asking you pretty much to come up with these two journal transactions. That's payroll. Now, if you're interested in payroll, of course, you can study it more. We have a whole separate course called Payroll Accounting, Business 8. We teach it online every semester. And I'm leaving this is from your book, these solutions. Again, this is the first transaction, employee payroll, and this is employer's payroll. You can look them over to practice more. Okay. So everything before was called known liabilities. Payroll, accounts payable, social security tax, unearned revenue. They are known. Now we have estimated liabilities. I don't know whom to pay, how much to pay, when to pay, but I can reasonably estimate it. And guys, there is a bunch of them. Pensions, health benefits, vacation. Now, these could get, especially pensions, could get quite complicated, and you study them in detail in higher level courses. The only one I want you to know is warranty, so I will skip the others. So warranty, the concept is similar to chapter 7 with accounts receivable. If I sell a car today, then any warranty that expenses that will come, whatever my policy, 5 years, I give you insurance policy, the first 10,000 miles. Whatever future expenses I will have in warranty, I have to report today. I have to report in the current period because I have to match revenues, right, with expenses. So I have to estimate. I don't know whom I will pay, how much I will pay, but I can estimate it, and I report it in the current period as a warranty expense and an estimated warranty liability. And then when actually customers come and bring the car back and claim warranty, I will not impact the expenses. I will not impact the income statement. So here's an example. On December 1st, a dealer sells a car for $16,000. Past experience indicates this is an estimate, reasonable estimate, that we usually pay 4% of the car's selling price in warranties. So I take 4%, multiply by $16,000, I get $640, right? $640. Look at your transaction. This is an adjustment. You don't have to do it every time you sell a car. Companies usually wait until the end of the month. They look at the total sales, multiply it by the estimate, and they debit expense. So this expense is now reported in December. It's reported matched with revenues. Your revenues and expenses have to be reported in the same period. Otherwise, your net income will be all over the place. And guys, look what I credit. That's a current liability. That's an estimated liability. We call it estimated warranty liability. It's like a pot, like allowance for doubtful accounts. It's like a piggy bank of warranty. And then next year, the customer comes for repairs and I replace for free $200 worth of parts. Look what happens with this piggy bank of warranty debt. I decrease warranty liability and I decrease inventory, right? But look, there is no expense here. Expense has already been recorded and matched with the revenue in the same period. So that's pretty much the core of the warranty liability you need to know. Estimated liabilities. Then, guys, there is this group called contingent liabilities. Well, it's really it depends on the future. We cannot estimate much of anything here. This is the idea. It's usually us being sued. There is a legal suit against us. And, you know, we don't know what the outcome is going to be. I mean, this is what GAAP says. GAAP says that if you can, if the possibility of you losing the case, probability of future sacrifice is probable. Probable is like considered to be more than 75% chance I will lose the legal case. Then, and I can estimate it, right? I can estimate I will lose, you know, I'm sued now and I will have to pay $3 million can be estimated. Then I have to actually record it. This never happens because if you say, well, there is a 75 or 80% or 85% chance I'm going to lose the case, this could be used against you in the court of law, right? You have a lawyer who will say, well, it's a 70% chance, it's a 20% chance. So if it's reasonably possible, you don't have to record this liability. You just disclose in the disclosures right here. I went to the United Airlines, right? And it says, you know, the company has certain contingencies resulting from litigations and claims incident to the ordinary course of business. We believe that, you know, blah, 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 blah. There is nothing specific. It doesn't impact your bottom line, your income statement, or your balance sheet. But you are following GAAP and you're disclosing in the notes to the financial statement that you've been sued. This is an example of a contingent liability. And then, guys, there is one ratio here called times interest earned ratio. This is the formula. We take interest before, net income before interest and income taxes, so-called NIBIT, net income before interest and taxes, and we divide it by interest expense. So this factor shows to us that if income before interest and taxes varies greatly from year to year, then the interest we have to pay on the existing loan can increase the risk that we might not be able to provide positive return and pay our interest charges. So it's of interest to lenders to see if the company has enough net income to make payments on bond interest, on loans interests. And usually the higher the better, right? So this is an example. You go through this and the ratio is called time interest earned. Okay, guys, thank you so much for attention to this chapter and take care.